Okay, so welcome to the final session in our discussion for strategic case study, July 2026 examination as we get ourselves excited and bring a closure on the discussion on the case study. We've spent the time in looking at the few issues we need to understand based on the syllabus because, as we mentioned, the objective is the syllabus, right? Not necessarily what we have done based on the case study that has been presented, but the objective is the syllabus. And so the question we then have to ask ourselves is, are we good in the syllabus? Have we covered the things that we must understand, the content of the syllabus? Because that's what's going to be featuring in the exam hall. So what we want to do quickly is to just share our thoughts on some of the few key issues that we are left with to talk about briefly in the next few minutes, and we should be out of here and be ready to go into the exam hall and do what must be done at the end of the day. So we started our discussion in the session one of the Preseen analysis, Destiny Group, the Preseen that we have available. And we shared our thoughts on a couple of things that we must understand when it comes to the Preseen. A couple of things that we highlighted were number one, the issue in respect of the current position of the entity. And so we realized that the entity is generating quite some amount of revenue, and they are the only entity currently possessing an exclusive air carrier license for freight forwarding in Ghana. And we saw that there are a couple of problems associated with the entity, and we emphasized that there are severe diversification into salt, real estate, and then also agriculture. And then capital allocation, there is some imbalance on the capital allocation because in the case study, here the entity is having about 1.4 billion cedis in debt, long-term debt. However, the entity paid a dividend of about 460 million. So there is some imbalance there that we have to be mindful of when it comes to dealing with the issues in respect of this company. So we saw these as the problem, the over diversification of the entity structure, as well as the capital imbalances. We also saw the divestiture and the integration issues that the entity may have to divest the non-core assets so that they will fund the integrated air, sea, and land logistics ecosystem, because that's going to be crucial for the entity as a recommendation on our part. Then the fact that there are some issues in respect of risks and change management issues that we need to be mindful of. So we shared our thoughts on some of these things. Narrowing down, we looked at the PISTO framework, spoke about the political factors, economic factors, social factors, technological factors, environmental factors, the legal factors, and what the entity is supposed to do generally. We mentioned that in the political factors, there is an immediate opportunity to dominate in the intra-Africa trade corridors because of especially the African Continental Free Trade implementation and the governments of Ghana's port expansion project. So these create a platform for our company to continue to expand and grow. Yes, Ghana is peaceful. The industry is highly regulated, but Ghana is peaceful and the investment of Destiny Group is protected. On the economic side of things, there is high domestic inflation and currency volatility. Again, we emphasize that the context of this question is in 2024. And 2024, the economy was in the ground. So you have to understand where we were and where we are now to understand what is going on. And we said urgent need for forward contract and hedging and shared fleet cost efficiencies will be a good strategy to handle some of those economic issues. And we shared our thoughts on that. On the social side of things, e-commerce boom driving last mile delivery demands. Like we said, the last mile delivery demand refers to where people want to be at home and have their goods and things delivered to them at their home. So e-commerce is making people to demand that. And so we said that our entity Destiny Group must leverage its existing corporate social responsibility, reputation to attract e-com conscious retail giants into the market in respect of that. And that is something that we must understand. On the technological side of things, AI, route optimization, and warehouse automation is a key thing. Now, that's a threat of technological obsolescence, and that requires heavy capital expenditure in a lot of um, ERP system, and our company is adopting some level of technology, as we said, but not that intense. But we shared our thoughts on that. Environmental issues very important. There should be increased scrutiny on the fleet emission, right? So the entity can accelerate its ISO 14100 certification and transitioning into green fleets. That's very important because that will then help the organization to shape its reputation in looking at the social and environmental issues. Then the legal issues, as we mentioned, friction with ecom AI valuation software. The entity should deploy some embedded compliance units to prevent demurrage penalties and all those things, because that will help the entity to reduce its cost and increase its efficiency on the overall. So those are some of the issues that we shared our thoughts on the pistol framework. On the environmental issues, we spoke about, on the industry issues, we came in with a industry analysis, Porter's five forces. Threats from new entrants, we said it's not high, it's not low, it's moderate, because although there are high capital that you must come in with, there are some low barriers that people can enter into the niche environment to help them still get access to the market and render the service that they have to render on the overall. On the suppliers aspect, we said it is very high because global shipping lines like Maersk and MSC, volatile fuel providers, okay, they detect the margin ceiling. So that's very high there. And we discussed the various strategies our company must put in there. Then for the buyers, we said yes, because the industry is highly competitive and there are a lot of players in the market. That means that switching cost is literally close to zero. And so buyers have strong bargaining power because they have information about what is going on in the market and they can make various decisions in respect of that. The industry is highly competitive. Threat from substitute product, we said, yeah, it's now evolving. So, it's not something that is really a threat now. Nonetheless, it's not something that the entity should be taken for granted going into the future. And so in putting that together, we said that Destiny Group cannot compete on price. Survival requires building technology-driven, one-stop shop ecosystem that locks clients in. And that is very important when it comes to understanding what is going on at the end of the day. Then we looked at a key stakeholders that the entity is exposed to, the Mendello metrics, and the various things that we must understand there. We spoke about the various issues in respect of what is going on within the organization, the core issues, and then the non-core issues of the company. Then we came to the board structure, interrogated the issues happening in the board. We said that the board may seems to be, over-indexed, and there are some gaps in the board, like nobody is on the board with deep supply chain and aviation expertise. Nobody is on the board with corporate law and cross-border compliance. If an entity of this size is seeking to go global and operate in various economies in the world, their board should have somebody who have expertise in that. Then change management and HR strategists, that is also something that is lacking on the board in respect of that. Then we didn't also see committees of the board and all of that. So these are some of the issues on the board, and we spoke about some risks that the entity is exposed to, having the understanding on that as well. Then we interrogated the money that is coming in, the dividend that the entity is paying, and its position in respect of what is happening. Because if current dividend policies must be replaced with probably a residual dividend policy, because you have to expand. You need money to expand. You cannot be paying dividend before you think about expansion. So maybe, and we spoke about the various dividend policies available. So probably the entity can look at this residual dividend policy where dividend is only paid after we have made a decision on the capital investment project that we are going to be undertaking on the overall. Then we said if the entity is seeking to achieve its objective of that international growth, then what are the options available? We were not told in the case, but we mentioned that there are various options available, and we analyzed the options, the risks, and then what the entity has to do, the various options available, if you remember in that case. Then we spoke about the TARA risk management framework, pretty important there, reducing the risk, transferring the risk, accepting the risk, and avoiding the risk, you know, and all of those things that we need to understand there. Then we came to change management. That was the last thing we were on, and we called on the John Carter's change management model, Kurt Lewin's change management model. We spoke about the consultants Gemini for our model, and we spoke about the ADKR as well model in respect of the change management. We said change management is crucial because looking at where the entity is going, there has to be changes in the culture of the company, in the structure of the company, and the whole board of the organization. And we went through these models to discuss the various things that we must understand there. And so at this point, we need to then look into the finances of the entity. And we saw the various financial issues that we are having from the entity's position. And we want to just take some discussions from there. But before then, let me touch on this quickly. The strategic directions for the entity. We spoke about this lightly, but I want to emphasize on that quickly. Again, whatever discussions we are having is our premise on the Preseen, right? And so in the question, it is not too much clear for us in respect of the strategic direction, what the entity would want to do, but we're going to see much of that in the additional information in the exam hall. Nonetheless, we said that the entity must focus on logistics and aviation because that's going to be important. And so they have to streamline operation by prioritizing these areas rather than spreading too thin into non-core sectors like real estate, agriculture, salt production, security. Why is this important? Because this will build brand identity and make us as a specialist logistics leaders in Africa. So that's the first thing there. Number two, the regional expansion and market penetration and soft growth matrix. And they already have presence in Egypt and Morocco. And we mentioned the importance of Egypt and Morocco in the industry that our company, Destiny Group, is operating within, emphasizing the importance of that. Technology and digital transformation, this is important because we mentioned this will improve efficiency, transparency, and customer satisfaction. However, we said that means the entity would have to invest further in automation, AI route optimization, blockchain for documentation, because that is going to be crucial, and then some real-time tracking system. All of those things will be crucial in leveraging technology in order to make the entity efficient, more transparent, increase customer satisfaction, and most importantly, increase the profitability of the entity. Not forgetting the environmental impact of the entity's operation. And so sustainability and ISO certification, very important. And we mentioned that the entity may be seeking to accelerate its green logistics initiative. How do we use fuel-efficient fleets? How do we use renewable energy in warehouses? And how do we use eco-friendly packaging for everything? Why is that important? Because it will enhance the reputation of the entity. It will help meet regulatory requirements and also attract multinational clients with sustainable or sustainability mandates. Then we were told in the question that the entity also has some strategic partnerships. So the existing partnership with the Ghana Port and Harbour Authority through the Electrochem Terminal, the Global Aviation people, sorry, all of that is important. So the entity can expand the partnership with major shipping lines, e-com platforms, and inland port operators. Why would that happen? What would the benefit be? It will increase the market's reach, reduce dependency on single partners, and strengthen the competitive position of our company. So these are a number of strategic direction that the entity is going to be going into. And each of these strategic directions could be brought up in the exam or with an additional information in the unseen information when we get to the exam hall, where the examiner would expand on any of these, which would then form the basis of some questions between 15 to 20 marks in the exam hall that we need to be mindful of. For now, there is nothing we can say apart from the discussions that we've had and then the various issues that we've gone through in respect of some of these strategic decisions that a entity can take. And so in bringing the discussion home, we look at the financial statements of our company, Destiny Group, and we were given the financial statement for 2024-2023, the consolidated financial performance. We have the consolidated statement of changes in equity. That's where we saw the gargantuan dividend that was paid, about 87% of dividend from the profit for the year paid out, right? So 80% of the profit of the year was paid out as dividend in that place. Then in the statement of financial position, quite a number of issues happening there. So from financial performance perspective, what are some of the things that we will talk about? Certainly, the key ratios would have to be calculated and interpreted on the overall. From the operating profit margin, which is going to be your operating profit divided by revenue, we are seeing a marginal increase in the current year from around 6.02% to around 7%, right? So we can say there is improved cost control or maybe pricing power. The entity is able to price or charge at a quite higher price in respect of that, because they offer quite related auxiliary services. They could charge or get more money from a single customer because of those connected auxiliary services that they offer. So that is the issue there, and we must know about that. Revenue grew by just 9.9%, but operating profit margin grew by a little over 28%, and that is a crucial thing for the entity. On net profit margin, also increased marginally, just a marginal increase, but it's depicting that there is a stronger bottom line performance after finance cost and what? Tax. Because at least bottom line is good. Top line item is good, which is the revenue, but the bottom line profitability has to also be positive, and we are seeing a marginal increase in that. And from absolute figures here, we are seeing that profit for the year from 420 in 2023 to 550 in 2024. So that is a good sign for us to see about the company in question. Then returns on assets, which can also be referred to as returns on capital employed, calculated in various ways. We see that there is again an increase, about 2.18 percentage point increase, which is simply indicating that the entity may be efficiently utilizing its assets in revenue generation and by extension in profits generation for the entity. And that is a good sign, because utilization of assets is crucial. If the entity has assets but not utilizing those assets well, then it's not a good signal for us. Then return on equity. We want to find out about the returns on the shareholders' fund. And we are seeing about 20.1% last year, now increased to about 26%. So it tells us that there is an excellent return for the shareholders, right, in respect of that. And there's an excellent return for shareholders. No wonder the shareholders expected more dividend. Probably that is what triggered management to pay about 87% of the profit for the year as dividend to the shareholders, 460 million from the what was the profit? From the 550 profit they made, they paid 460 million to the shareholders. Why? Because, they are seeing the ROE to be of a higher return. So if the ROE is increasing, why not give us more money in respect of that? So those are some of the issues that we can highlight in terms of the profitability ratios. The whole idea then is that profitability is improving steadily. We can say that. and the company is becoming more efficient in converting revenue into profit, and likely due to the scale benefit and its integrated logistics operation and the volume of growth in all those things. And that's why we are saying that if this is going to be sustained over time, then they may have to restructure the organization and possibly get rid of some of the not some of the other operations of the entity. And so this is where possibly BCG model may come in. Again, we don't know what the examiner is going to be bringing in the additional information when we get to the exam hall, because the additional information will change a lot of conclusions that we are reaching here. The additional information will change a lot of conclusions we are reaching here. But the additional information could bring data, and the entity would have to use maybe BCG framework and find out which of these services are dogs, which of them will be regarded as problem child, which of them will be star, which of them will be cash cow. Then that will inform the entity to make a decision. Or hey, maybe we can go to the Shell directional policy matrix, or we can use the how do we call it, McKinsey and General Electric business screen. Whatever can be applied to be able to help the entity to make a decision. Now, since we don't know that, but there could be a data in there could be an information in the unseen data, unseen information that we're going to see in the exam hall, where we may be told that some of the other operations they are in are separate entities. Then we are going to be dealing with corporate parenting, as we discussed at length in respect of that, because we've addressed various issues there. And so going into the future, the entity must really optimize its operations, restructure, divest, and get rid of some of the entities that they are in, or operations or sectors that they are in, and lean in on the areas that they have expertise in to improve profitability going into the future. On the liquidity side of things, we will see that liquidity or current ratio, which is assessing the ability of the entity to pay short-term debt as they fall due, has almost remains the same, but which indicates that adequate short-term liquidity, current assets comfortably cover current liabilities. But when we come to quick ratio, it's not far from long, because it's very healthy. Inventory is negligible, because if we look at the inventory that they have, go to the statement of financial position, you look at the inventory, it's sort of negligible. Yeah, in monetary term, that's 15 million, right, in inventory for 2024 as compared to 10 million in 2023. So you will say it's huge. But if you look at the inventory they have, the trade receivables they have, it's significant. And so that's where maybe a question can come. How can they ensure that they collect money much quicker from the debtors? And this is where trade receivable management comes in. You learned this in financial management. And so what can they do to get the money quickly from their debtors? They can offer early settlement discounts. They can restructure their credit policy to sell to only customers with good credit rating, so they can get the money on time. They can do invoice discounting to be able to get the money on time. And then they can also do debt factoring with recourse, without recourse. And the advantages and disadvantages of all these methods of management of trade receivables will be crucial, because if you take their current assets, you see that the trade receivables represent a significant portion of their current assets. So how do they ensure that they collect money quickly, manage trade receivables well? It's a question the examiner can ask us. It's part of working capital management, as we mentioned. You learned all these things in financial management, so it's not like they are new things that you are going to be looking at here. And so the liquidity position of the entity is stable and reasonable for a company of this size, which is capital-intensive company. No solvency, no immediate solvency issues can be raised. However, as I said, there is a high trade receivables, and it represents a significant portion of the current asset. And Nuntina, I said, the examiner may come up, and the entity must manage its working capital well. How do they do that? Is it possible for us to manage the trade receivables well? What are the alternative strategies available? And you should be able to explain that. We know there is a 20-mark question on finance coming up, but that finance question on 20 marks coming up, it can come from anywhere, as we said: investment appraisal, treasury management, dividend decision, working capital management, various issues there. Then some of the efficiency ratios to talk about: trade receivable days, 53%. I mean, on the average, this is reasonable for a B2B client in logistics and supply chain, okay, that we are expecting them to have. Trade payable, 44 days, and that is key there. What it means is that they are using cost of sales via operating expenses, and there is, on the overall, a good working capital management policy by the entity. So in this place, that's what we can say there on the efficiency aspect or side of thing for the entity. On the long-term solvency gearing, debt to GDP, we are seeing that there is, some level of 34%, 40% approximately, if we look at debt to total capital in respect of that. Now, that's not a big deal like that, because you can calculate the interest cover ratio. If you go to the P&L, you can calculate the interest cover ratio, and that's going to be the 6. So for 2024, the interest cover is going to be the profit before interest and tax, which is 695, divided by the interest of 70. And 2023, profit before interest and tax, 545, divided by 65. So if we look at the interest cover, 695 divided by 70, that's about 10 times. 545 divided by 65, that's about 8.4 times. So if you look at it, and then you come to the statement of financial position, long-term borrowing, it has increased marginally, right? 100 million Ghana cedis. It has increased. However, you could see that the interest cover has also equally increased, which tells us that, yes, although the entity may seem to have its debts increasing, the entity may be utilizing the debt efficiently in generating what? Profits for the year ended under review. Do you get the idea? So it's not a worse position for the entity to be in, looking at where they are. All right? But here's the play. The entity uses debt to fund its growth, because you saw that PPE went up, okay? And this leverage is amplified by the ROE, but increased interest rates and financial risks in a high fuel cost, volatile currency environment. Because if you borrow more, it's a good thing. Debt is tax deductible. It's a good thing, but it's going to put a lot of stress on you as a company because of the finance costs that you have to pay every year as a company. So those are some of the things that we can share about the long-term solvency. Now, as we mentioned, what then are the financing options available? We spoke about this at length in the previous session, so I'm not going to repeat it. But what then are the things we must understand? It is important to understand what are the short-term sources of finance, what are the long-term sources of finance available, Islamic finance, and all of those other issues that we highlighted and spoke about in the previous session. Very important here, because if this entity is going to be doing something going into the future, the money they have currently, cash, that they have at their disposal is just 160 million. That's the cash they have, 160 million. If we add the money from their debtors, that will give them about 2 billion, okay? Ghana City, give and take, okay? No, it's not even up to 2 billion, sorry. That'll be closely like 1.6 billion Ghana Cedis if we add the receivables. But these are short-term issues. You can't use these short-term things to finance long-term projects. And so whatever the entity is going to be doing in the long term, they have to look for money. And that's why we mentioned that we need to know about the long-term sources of finance, the advantages and disadvantages, the limitations surrounding all of those long-term sources of finance. Or maybe the entity is now seeking to be listed on the Ghana Stock Exchange. what are the requirements for a listed company? If they are going to be listed, then this Banku board structure they have has to be changed, because there are standard requirements that a board of a company, of a listed company, must be before they will be allowed to be listed, corporate governance issues. And so all of these are complex discussions and areas that we have to be mindful of when it comes to analyzing the entity's performance and position on the overall. There are some other key observations which we have highlighted, but also we have included that for you to see. Revenue is growing by 9.9%. Dividend payout about 84% of the profit for the year. It's not a good thing. I mean, it's indicating a high dividend payout. Okay. But although that will give the shareholders confidence to hold on their shares and not sell the shares and not revolt against the management of the entity, it presents the entity with limited internal funding for growth. Okay. Limited funding for growth. Because if we follow the pecking order theory, if an entity is looking for money to expand and grow, they go internal, retain earnings. Then they can go to debt finance before they go to the shareholders' equity finance. The reason that debt is prioritized over equity is because of the fact that the debt is what? Tax deductible. And as we said, yes, debt is tax deductible, but then when you get to the advanced taxation class, you will understand that not all debts are tax deductible. But for now, in this environment, we will say that debt is tax deductible. So debt will be prioritized over the equity of the entity. On working capital, we said current assets are up, and this is significantly driven by the receivables. Trade payable also increased and helping to fund the operations of the entity. So in a way, the entity is using trade payables to fund the day-to-day running of the organization. Because if you look at trade payables as well, it has increased. So the entity is delaying payment to the suppliers and using that money to run its affairs. It's good. But there are disadvantages of that, right? Because if care is not taken, suppliers are going to be angry. So it may affect the credibility of the entity, the creditworthiness of the entity, Destiny Group. Then suppliers in the future may decide not to sell on credit to the entity. Because in as much as you are using our money to run your business in the short term and delay payments to us, we also need money to run our business. So that is the trade-off that we need to understand there. Then goodwill. I mean, stable at this indicates that, past acquisitions are contributing to the integrating strategy, because we saw that on the face of the statement of financial position, there is goodwill there. It remains the same. Now, goodwill here means it's a consolidated financial statement. So you know that the goodwill is coming as a result of expansion, as a result of acquisition. So it means this company's expansion strategy has been expanding through acquisitions. Expanding throughout, because there are two ways that we mentioned that we can expand: internal or organic expansion, where the entity starts the business from scratch. Or the entity can say, oh, I want to go into this sector. Okay, which company is there? Let's go acquire them. And so the examiner can put us in a position where we are supposed to then provide answer or argument for or against organic expansion strategies and expansion through acquisitions or growth, mergers or strategic alliance. Because all those are strategies that an entity can use to expand. As we said, the operation in Morocco and Egypt, we don't know how it's done. Probably they acquired some subsidiaries there. We don't know. Maybe it is through strategic alliance. We don't know. Maybe it's a merger arrangement. We don't know. But the goodwill on the face of the financial statement tells us that this entity's expansion strategy is significantly or partly due to what? Acquisitions of other companies. We may be called on to give and discuss argument for or against those expansion strategies that we need to understand. And that is something that is of concern that you need to be mindful of. And the overall financial health of the entity on a SWOT analysis environment, strong profitability is there, liquidity is good, efficient operation is there. The entity has a solid asset base. That one we cannot, take that for granted. But there are some weaknesses there because they are depending high on debt for growth. That's not a good thing for a company. Yeah, according to Modigliani and Miller, you learn this in financial management. An entity may be geared 99.999% of the time. But, if you are growing through debt, that's too much. At a point, you have to break. At a point, you need to bring in equity shareholders. At a point, you may have to decide to be listed on the stock exchange so that you can raise some money from equity shareholders like Casapreco did, right? Because Casapreco has a lot of, quite a number of debts on its statement of financial position. But they needed money, 750 million Ghana cedis, I think so, to establish a new factory. They could go for another debt, but they sat and realized that that'll be too much stress. How about let's build a bigger company? And so then they let the company be valued. Then they got listed on the stock exchange, got that money through equity. They are not under obligation to pay dividend to anybody. They are not under obligation to repay or repurchase their shares. So they are getting the free money to now use to fund the business. Now, that equity coming in is going to improve the gearing position of the entity. And that means now the entity can even go further into the future after repaying some of its covenant debt and borrow additional money. So it is important we understand that although things are we see things to be, nice, beautiful, there are some limitations on the high dependence on debt to finance the growth of the company. The next one, significant trade receivables exposure. As we mentioned, there's a potential for bad debt. Yeah, because remember, customers have strong bargaining power. I mean, somebody owes you, they don't pay you, and they start buying from another person. It means you got to write the debt off as bad. Oh, you will take them to court. Okay, go. I don't know. Oh, you will use debt factoring. Let's see how far you can fight that. So trade receivable management is crucial. That is what I mentioned earlier, that we may have a question as part of working capital management strategies of the entity, how they should manage their trade receivables. And there are various alternative ways to manage their trade receivables to reduce any bad debt exposure, because it's likely that this money that we see here under the trade receivables, 1.4 billion, 1.45 billion cedis, that's a significant amount of money in receivables. Even if 10% of that goes into bad debt, that's a big blow to the company. And so management of trade receivables is going to be seen as a weakness of this entity. Then the high dividend payout, it's too much. 84%, that's ridiculous. How about future expansion? So it's a weakness. Like we said, it's good because shareholders will be satisfied. But it is bad because now it limits the entity's ability to take advantage of opportunities. Because right now, if there's an opportunity to acquire a competitor, or there's an opportunity to expand, there's an opportunity and they have to raise money urgently, how much money do they have? Currently, the physical cash they have is just sitting at the bank about 160 million Ghana cedis. Maybe it wouldn't be enough to finance the expansion or the strategies of the entity. They already have some debt, 1.4 billion Ghana cedis. Maybe their finance house may not be willing to give them additional debt finance, looking at the position of the entity. And so the dividend payout policy of the entity, it's something that we have to really look out for, and that is part of a weakness of the entity. And certainly the operating margins, relatively thin. It's good, but, may not be too good for an entity. I mean, how far will you grow if your operating profit margin is measly around 7%? I mean, how far will you grow? If it is above 10%, it's okay. 15%, yeah. 25%, that's a sweet spot to be in. All right, 25% upward. That's a sweet spot to be in. It means that, you are charging premium prices at the end of the day, getting a lot of returns on the investment. So these are some of the weaknesses. So you see that it's like SWOT analysis, all right, strengths and weaknesses, but we are just focusing on the financial aspect of the entity. But remember, we discussed SWOT analysis earlier in the previous discussion. So about the financing issues, these are some of the things that we can add to the SWOT analysis environment of the entity. And so based on where we are now, based on the information provided to us in this advanced or Preseen information, this is what we can say about the financial performance, financial position, financial health of the entity in respect of that. So I'm seeing a question coming up. Nhyira, what if the dividend paid was the first since the company commenced, or was after a long time from the previous one, hence the high amount? Even so, it doesn't that is even worse. All right, innocent. If that is the case, it's even worse. Because if you have not been paying dividend, then all of a sudden you declared huge amount of dividend, the value investor would then realize that, oh, this company has no future. This company is going nowhere. This company doesn't seem to expand again. Oh, they have reached their peak. Oh, so this is how far you guys can build a company to. I thought you guys said you are doing something exponential. I thought you guys said you want to become market leaders in the Africa intra-continental trade department or sector. Why are you paying huge dividend now? Because investors react differently to some of these decisions. So if we come from your angle, it's even worse. Do you get the idea? It's even worse. But you can see from the financial statement that this is not the first time. Okay, we don't know because we don't have the changes in equity for 2023, right? So we cannot determine whether this is the first time or not, right? But if this is the first time, it sends bad signal to value investors. Do you get it? It's a right assumption to make, but it doesn't justify the amount because it tells them that there is no hope for the future. So they will take the dividend and quickly sell their shares. Looking at the fact that the entity has significant debt on its statement of financial position, management doesn't want to grow again. It's okay. We'll sell our shares and go away. Do you get a thought process there? So that's even a worse reason for paying dividend because it will send bad signal to the market and value investors will start just selling their shares at the end of the day. So that's what we can say there in respect of that. But as I said, it's a double-edged sword. So on the other hand, yes, some shareholders will be happy. Oh, finally, this company has declared dividend. Hey, I've been holding on this share, Now they have paid dividend. Hallelujah. And if you're not careful, when those hungry investors, they take the dividend, they will still sell their shares. And they get rid of the business. So in all sides, it's good like 5%, 10%. It's bad like 90%. Do you get the idea? It's bad like 90% on the overall if we go with that assumption with your strategy. Okay. What else? Any other questions? So that is the financial analysis of the entity. Then some few other issues, corporate parenting style. We've already addressed that, so I'm not going to go into that place. The risk issues that the entity is exposed to, we've explained that at length and the various ways those risks can be managed using the TARA framework, using the ISO 31000, the risk management system, risk architecture, and all those things. So I'm not going to repeat that again because we've already done that. Then a couple of other risk issues. We have addressed this as well: the fuel price volatility, the demurrages and delay. With cybersecurity risk, because in this information technology environment, cybersecurity risk, exposure, hacking, those things, the entity may be highly exposed to that as well in respect of that. So we've already addressed some of those things. So I'm not going to be repeating them because we've addressed them when we're talking about risk management, if you remember earlier, and we know the various risks. In the pistol framework, we did the same thing, spoke about all the risks that the entity is exposed to and how the entity can hedge, manage, eliminate, or reduce the impact of those risks on its operation. So we have addressed that as well. Then organizational structure is going to be crucial because we don't know this kind of company, what organizational structure will be appropriate for them. And so please, as I said, you got to make sure that you read on organizational structure because it's crucial. Because if you remember, we mentioned this at the beginning of our discussion in the earlier session when we were talking about this here, that when it comes to strategy into action, the SAF principle, change management, organizational structure, and culture. So please read on organizational structure and culture because we may then be put into a position where as a consultant, we may have to recommend which organizational structure will be appropriate for the entity based on where the entity is now going, based on where the entity is or how the entity is now going to be designed. Again, the additional information will change how everything must be done. So we have to know about it. On the overall, decentralization will be a good thing because, looking at the nature of operations of the entity, having that centralized system is likely to have a lot of difficulty, especially they are having operations in Morocco, operations in Egypt. If you want to centralize everything at the headquarters in Kumasi, Ghana, that will have a lot of significant risks associated with it. So possibly it'll be prudent for us to have an understanding on having a different type of organizational structure. So decentralization in respect of that. Now, the complexity with that is that the head office in Kumasi faces challenges of maintaining oversight while ensuring these remote units, which likely operate differently from the Ghanaian logistics market and align with the group's vision. So decentralization is going to be helping a lot. Sometimes we can have what we call functional integration. Here, the group must decide if the international units are standalone profit centers or if they are integrated into the central, that is the destiny shipping or aviation or the logistics division. A pure functional structure may struggle to coordinate across borders, whereas a matrix organizational structure where managers will report to both regional and functional heads might be necessary to ensure global standards are met. So, matrix organizational structure may be a preferable organizational structure as compared to the functional organizational structure in the context of this question. So please, in the context of this case. So please, as we mentioned in the session 1 about the things that we must understand, you want to make sure that you put yourself in a position to read on organizational structure, organizational culture, because it's very important. Please, for inventory turnover, do we take operating cost as cost of sales since it is not clearly stated here? Yes, because of the type of organization in question. Yes, because of the type of organization in question, we could take the operating cost to use that as a calculation here in respect of that. But even so, because if you check the kinds of calculation that I did in my flow, you realize that I didn't even talk about the inventory issues. Do you get the idea? I didn't even talk about inventory issues. So maybe about inventory, instead of doing inventory turnover, you can rather do inventory holding days. Okay, because inventory holding days, maybe we can do, let me see. Okay, it will come back to the same idea on the operating cost. So yeah, you can use the operating cost and to do the calculation because we don't have cost of sales. So you can use the operating cost to do the calculation. And that should lead you to getting an answer. Since it is not clearly stated, and as the operating cost seems to have other administrative and general yes, but we don't have any option. You get it? We don't have any option. So if you want to calculate the inventory, how the entity manages the inventory, the cost of sales is the best bet to use. Unless otherwise, in the additional information, you may be given a breakdown. But it doesn't look like that because if they will, maybe would have seen that they will say, or maybe note something. But we don't know. Everything is possible. So in the additional information, possibly a breakdown of the operating cost could be given, in which case then you may have the cost relating to inventory issues. Then you can use that to calculate the inventory turnover or the inventory holding period. If not, and we still have to calculate these ratios and analyze, then you can use the operating cost in respect of that. But the reason why inventory is also not an issue here is because it's really not something significant here. As we mentioned earlier, okay? It's just 15 million cedis. Looking at a company that is having almost 1.5 billion in trade receivables, 160 million in cash, about 2.6 billion cedis in assets, inventory is not an issue because it's not a company or an entity that keeps inventory. So that's why really inventory turnover or inventory holding will not be a concern or ratio we have to calculate here really. Do you get the idea? Because they provide inventory management system or services to organizations. So that's part of their revenue, the top line item revenue. But they themselves, the nature of their operations, don't keep inventory. What are they keeping? What inventories are they going to keep? Inventory of spare parts, possibly, for the fleet of vehicles that they have. Inventory of consumables to be used in the office. Spare parts is going to take a significant portion of their inventories for a company like this. And consumables. So they wouldn't have normal inventory like a retail company or a manufacturing company will have, like inventory of goods to be sold. Do you get the idea? So because they are a service organization. So that's why inventory is not really something that we have to be too much bothered about when it comes to ratio analysis or ratio calculation. So that's why I didn't even come up with it when I was putting together my calculations on the ratios. Does that make sense? That's the idea there. That's the idea there. Then we come to the final aspect, which we also spoke about, management orientation, the EPRG framework. So we've already spoken about this, right, in the discussion, that the international strategies, the entity is already operating in Morocco and Egypt, right? And so if they're already operating in Morocco and Egypt, what kind of management orientation are they using there? If they are seeking to expand into other markets, what management orientation do they use? Ethnocentric strategy, we've spoken about it, meaning that the home country, Ghana, is better or seen as superior to other countries. And so the strategies, the product line, and everything that works that we are doing in Ghana, we're just going to take the same thing to Morocco, take the same thing to Egypt. It means that the organization would then use a centralized organizational structure. So those markets, the managers there will not have autonomy because everything must be done as per the directives of the parent or the head office in Kumasi, Ghana. And so it is that reason that we said in that case, they are going to be adopting a strategic planning corporate parenting style. So they will be involved in the day-to-day running activities of the foreign operations. That is what ethnocentric management orientation does. But we said that an ethnocentric management orientation may not work on the grounds that Morocco and Egypt have a different, systems, culture, things in place relative to Ghana. So you cannot take the way things are done in Ghana, human resource management in Ghana, and various things in Ghana, and take it to Morocco and succeed. You're going to fail. So the opposite of that is the polycentric strategy, where all the SBUs, right, in Morocco, Egypt, and other markets will be seen as autonomous. They will be on their own. And so the entity will then adopt a decentralized organizational structure in place because they leverage local expertise to have the local knowledge to manage those strategies in respect of that. Then the issue about geocentric, where you are looking at where we are, right? Because if you are the entity wants to be master of Africa, we don't know if they were going to be expanding, because remember we said Morocco and Egypt gives them markets to Europe, North America, and those things. So maybe the Morocco, the North Africa market, we can say they all behave in a certain way. Then Ghana, if they want to go to Nigeria and other West Africa countries, we can say, oh, all West Africa countries behave in a certain way. Geocentric. But looking at this company, we may assume or recommend to them that, sorry, they do the polycentric. Treat every market as a distinct market. That way we adopt the strategic control, corporate parenting style, because we leverage the local knowledge to be able to allow them to do what they must do at the end of the day. All right? So those are the issues. We've already discussed this. I'm only repeating it and bringing your mind back to it. Now, the challenges for management here is that they have to move towards a geocentric orientation. The company will need to invest in unified digital infrastructure that is harmonizing WMS and ERP systems so that data captured in Egypt can be analyzed alongside data in Ghana to improve the overall group efficiency. And so if the entity wants to do that, they are going to be facing some strategy. Now, so you see that a lot of the things we are talking about goes back to the fact that the entity must make some significant investments. And that is where we said, okay, if they have to make investments, then we have to appraise those investments. So the investment appraisal method. If they have to make investment, where do we get the money from? Long-term sources of finance. Where do we get the money from? Maybe we have to get listed. Maybe we have to issue loan notes. What type of loan notes do we issue? Zero coupon bond, deep discount bond, convertible loan notes, unconvertible loan notes, cumulative preference shares, uncumulative preference shares. What kind of debts? And the examiner has done this in the past, just under this new syllabus, where he just said, write short note on the following, or explain the entity wants to issue some loan notes on the Ghana Stock Exchange market. Explain the type of debt instrument that the entity can issue. Or the entity can use Islamic finance. Mudaraba, Shakuk, Ijaira, Mubaraha, all of those guys. You learn these things in financial management. It's not my duty to teach you that one. If you have forgotten them, go and learn them again. That's your job. And all these financial issues are available in the key summary notes, just for your information. So it's not like I'm saying, go and read something somewhere, go and look for something. No, it's just in the key summary notes, because those financial issues are there that you can read there. Please, should a polycentric parenting rather than not go with financial control? No, it depends. It can go with financial control. It can go with strategic control as well. It depends. Because as we said, depending on feel and benefit, if the home country has some knowledge, some expertise in respect of certain needs that the SBU will require, then they will let them make certain decisions on their own, But then when it comes to other decisions, they will still have to come to the head office. Do you get the idea? So it could be financial control or strategic control in respect of that. So we can give them full autonomy or partly, so that any investment decision up to 10 million Ghana cedis, take it. Anything in excess of 10 million, please come back to the home country. So it can be the two, depending on the management's expectation of the people there. Because, we mentioned this. I think we discussed this, but probably we didn't emphasize it well. The board's decision to decide which parenting style to choose depend on a number of factors. Number one will be the philosophy of management. If management feels that, hey, if you allow people to manage things without being involved every day, then they will pursue their childhood dreams and they will run the company to the ground. In this world, you cannot trust people. If that is the philosophy of the board, then they will do strategic planning. So they will be involved in the day-to-day management of the entity. But if the board feels that no, if you assess that people are capable, give them opportunity. Just that don't let them do whatever they want to do. Put a hold on them. So they give them a range to go, but still have a chain around their legs. Then strategic control will come in. You can make certain decisions without our permission, but when it comes to other decisions, you need our permission. Or in some cases, the entity will think, hey, these people may have a better knowledge. Let's give them the finances. These are the KPIs. We're going to evaluate them every year. If they don't meet the KPI, we sack everybody, and that is all. Then they're going to do financial control. So management orientation will determine which one they will use. Number two, the skills and expertise of the head of the SBUs. If the SBUs possess the requisite skills, expertise, experience, then they are capable of doing their job. So you don't have to be there every day. So you can do financial control or strategic control. But if the expertise require, they don't have it, then you don't want to leave them to do whatever they want to do. You want to be involved in the day-to-day running. So for instance, maybe the head of the entity did their first degree and then they went to do an MBA. We don't care. 99.9% of the people graduating with MBA have nothing in their brain when it comes to managing a company, because everything they've learned is theory. 99.9% of the things they read in their MBA have nothing to do with the reality. It's true. I'm not trying to disrespect certificates, but that is the reality. 99.9% of the things read in MBA classes around the world, especially in our part of the world, have nothing to do with what is happening in reality. So people have MBA, but they have nothing in their brains in running a company. So yeah, the person has an MBA, but you can't say, but the person has never managed anything in their entire miserable life. How do we trust our company with somebody who has never run anything in their entire miserable life? And we saw this in the banking sector cleanup. Some of the banks which, the owners gave the companies to their children to handle positions that they don't have experience in, they ran the banks to the ground. Because certificates alone doesn't equip people. So if management feels that these people don't have the requisite skill, day-to-day involvement, strategic planning. But if management sees that, the head of these SBUs, they have been in supply chain, run this company for years. They have 10 years experience in ABC. And on top of that, they have MBA from this university. Then they are well able. So let's not be involved in the day-to-day running, because we believe they can bring their expertise on board. In that case, financial control or strategic control will come in. Do you see what we are talking about here? So the appropriateness of the corporate parenting style, what we are saying here is that it depends on the agenda of the board and what they perceive the board to be. That's why some of you may be working in companies where you are not trusted with any role. Because your boss sees you that if they give you the leash, you will take a mile. So they won't give you. Number two, they see you that you may not have what it takes to take certain decisions. So they can't trust you now because you may not have the experience. So sometimes you'll be like, this thing could have done it better than what my boss did. Yeah, you could have done it better, but they don't trust you. That's why they didn't let you do it. So those are the things that will inform management, the board, as to which corporate parenting style to go for. So their own philosophy, expertise of the head of the SBUs at the end of the day. And then if you want the strategic goal, to ensure goal congruence. Because if you allow people to run businesses in their own veins, they will do it. It's their childhood dreams. And they will end up pursuing their childhood dream at the expense of the dream of the company, at the expense of the dreams or strategic goals of the company. So to prevent dilution of dreams, if I can say that, to prevent dilution of dreams, whatever you want to do, write to HQ. Seek board approval before you proceed. That's it. And so these are some of the things that will inform the appropriateness of the corporate parenting style that the board may elect or choose to use at the end of the day. So there is no one fit for all. That's all I'm trying to say. There is no one fit for all. It will depend on suitability. How does it fit into the strategic goal of the entity? Acceptability. How does the board management see the SBUs, right? And then feasibility. Can they really do the job? If they cannot do the job, then every time they have to take permission from us. So that's what I want you to understand in respect of the corporate parenting style there. All right? That's all about that. And that is what brings me to the end of my discussion. But remember what we said. There are a lot of strategic decisions that an entity is seeking to make. Again, this case study is one of the riskiest case studies in the last few examination dates. As I said, it's a case study where the examiner gave you enough information to understand what you think you need to understand, or what you think he will be asking you in the exam hall. Also, then, take space is getting low. Oh, please give me a moment. I think my storage. Otherwise, after this meeting, Asembeba, please give me a moment. Let me just create. We are supposed to transfer some files from my MacBook, but it hasn't been done yet. And 1 terabyte is already gone. Let's see, what can I get rid of? La 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 la. Chale yentemona. Many are break. Okay, I can take you. I just need a little space to go. PSAF. S3 July 2025. What are you doing here? Okay. I just need a little real estate. We'll do the transfer later, so I can proceed. That was better. Okay, let's go. So the entity, the case study, the examiner gives us information to know what we think he will be doing in the exam, but he doesn't give us a lot of information to understand what the entity itself is seeking to do. And so we don't know. But here is the play. If the entity is going to focus on its strategic plans to expand and grow, they may need to prepare a business plan, as we mentioned, right? So as part of the financing objectives or financial objectives for a 10 marks area, the examiner may ask you to prepare a business plan for them to help them. Maybe they are seeking funding. Because as we said, if we look at the money they have currently, where's my pencil? They have 160 million in the bank. Okay, 160 million in the bank. If you compare that to the trade payable, trade payable is 1.1 billion. So it tells you that they cannot finance any long-term projects now. So they need money. If they need money, they may have to put together a business plan, or they are preparing to be listed on the stock exchange. And as part of the prospectus, there must be a business plan. And so there may be a need as a consultant, because remember we said our role in the examination or in the exam hall is the role of the consultant. Help the company prepare a business plan. And so just some few things here that we must understand. The business plan will have an executive summary, a brief description and strategy of the company, the market analysis and competitive positioning, the operational framework of the entity, financial overview, and then the strategic outlook, what the entity is seeking to do going into the future. So these are some key issues that can be covered in the business plan that we need to understand. So we just put together a number of things to give you an idea about how the business plan looks like. So for instance, the executive summary, just a brief description of the business and what it represents generally. Destiny Group is a Ghanaian-based or Ghanaian-owned conglomerate headquartered in Kumasi, providing comprehensive logistics and transportation solutions, including shipping, freight forwarding, aviation, warehousing, and projects cargo. With a vision to lead in intra-African trade, the group leverages its intermodal capabilities and infrastructure such as electrochem terminal to provide end-to-end logistics. Okay, to provide end-to-end logistics. So, that's it. Then the description of the business, what they are currently into, the value proposition. We've spoken about this. Offering clients seamless connectivity by managing the entire supply chain from inventory, warehousing to customs clearance and multi-modal transportation, because they have different models of transportation that they are offering. The market analysis is going to, and then the competitive position of the company is going to be there. So this is where Porter's 5 forces, some of the issues may come up that we need to understand. Then the operational framework, the various things that the entity is doing. Financial overview, because we need to know, in every business plan, we need to know how far the company has come. So that's the financial overview for 2024. And we discussed that at length already. Then where the company is going, the strategic outlook. So for instance, as I said, we don't know, but in the additional information, the examiner may give us some assumptions to prepare a cash flow forecast for 2025 or 2026. I'm thinking that definitely we may be having 2025 data there. So you may be required to we may be given an assumption, which we would then extrapolate or increment the 2025 data based on the assumptions to then prepare some forecast cash flows, because that may be part of the business plan preparation. We need to know, where is this company going? How much revenue are they going to be generating? Cash flow forecast, budgeted income statement, budgeted statement of financial position, if the examiner wants to bring us in those areas. So the future success of Destiny depends on its ability to navigate threats such as fuel cost volatility, currency volatility, and regulatory complexity. The group aims to further strengthen its position by enhancing investment in technology and fleet capacity, deepening regional partnership to capture transit trade, maintaining high standards of regulatory compliance to mitigate risks associated with customs clearance. So that investment in technology and fleet capacity may need money, may have to be evaluated. That exposure to the risks, some of the risks we spoke about, foreign currency risk management, may need to be hedged. How do we hedge it? Money market hedge, forward arrangement, leading and lagging, all those things are available. So that's the idea about the business plan, just giving you an idea about how it's going to be structured. It's a 10-mark question. The examiner did it in the last, examination, the last syllabus slide, where that came twice. There was a first time where the students were supposed to prepare a complete business plan, 20 marks. Then in another examination diet, students were required to just prepare an extract of the business plan, and the examiner mentioned the key issues to be mentioned in the business plan, in which case it was just 10 marks. And the reason, again, why that is important is because of where the company is and where it is going. And every company has a business plan, must prepare a business plan to understand where the company is currently at, where it is going, and most importantly, how the company's profitability can be achieved generally at the end of the day. And so in bringing our discussion home, as we mentioned, it's good to have an understanding of the analysis of the case study, but nobody cares about it. As I said, 60 to 70% of the conclusion you will reach from the Preseen is likely to be made nonsense with additional information. I am not scaring you. I am not telling you anything. I'm just telling you how the case study is, how the strategic case study examination is. 60 to 70% of whatever conclusion you think you have reached based on the Preseen is likely to be made nonsense when you get to the exam hall because of the additional information. Because now the additional information will come and you'll be like, oh, something I thought was a threat is no longer a threat. Something that I thought was a weakness is no longer a weakness. Something I thought was a problem of the company, and so they have to adopt these strategies, they've already solved it. So what do I do now? Let's go to the syllabus and let's get excited about what is in the syllabus. So that is why I keep on telling you, nobody cares about your analysis of the Preseen, because you're not going to take any analysis to the exam hall. It is all about what is in the syllabus. And Nuntina, I have emphasized, read on various issues that I've indicated to you to read, because it is about the syllabus, not your analysis of the Preseen. Because at this point, some of you have received 200 pages from Crocodile, 700 pages from Pit of Hell, 900 pages from Ejankuto, and you are scanning, jumping. It is not about analysis of the Preseen. It is about what is in the syllabus. And so when you get to the exam hall, you want to plan yourself out very well. Preferably, you want to use about 35 to 40 minutes of your time to plan your answer. Please stay with me carefully. So you're going to have 15 minutes reading time. That 15-minute reading time, you want to read the additional information to help you restructure your understanding of Destiny Group. Because definitely there will be restructuring of your understanding. Definitely, that I can guarantee you. 60 to 70% probability of restructuring of your understanding of Destiny Group. So you read additional information. Then you go to because you know the Preseen already, you just flip, and go to the additional information. Then you go read the requirements of the question. Now, in reading the requirements of the question, this is where you're going to be taking out, okay, question 1, what does it say? Question 2, what does it say? Question 3, what does it say? You take out, map out. Now, here's the play. In the 15 minutes reading time, you're not supposed to write. So that's why you got to use that time to read through the additional information to help you form new understanding. Then you start reading through the questions, but you got to hold your thoughts because you're not supposed to write. When they say start work, don't be in a hurry, you've read question 1, no, you start writing. No. In your answer booklet, open it and write on top, answer plan. There is a 99.9% probability that you will not do what I'm telling you to do. But if you do it, you will be thankful to yourself. Listen carefully. You write answer plan on it. What's the purpose? The purpose is to write your APO here. What do I mean? You've entered the exam hall. Things are fresh. So you read question 1. What is the question? You know the answer. Okay, so come and write the points down. Question 1A, write the points. Question 1B, you know the points. Okay. Question 2, okay, it's about market positioning. Write the points down. Don't write them in the question paper, because your question paper, you will take it home. You need it. So while start work that people are giddy trying to answer question, you are doing answer plan. It's going to come home in a moment. You go to question 3. This question, what is it? What is it? What is it? What is it? Answer. Write it down. So you write out the key pointers, the apostrophes for each of the questions that you remember. Maybe the first page will not be enough. The second page may come in. Continue your answer plan. It doesn't matter. Finish. The governance area. Oh, the examiner said I should talk about maybe the governance code, or I should talk about issues in respect of risk management. Okay, then I will use the TARA framework to do the management of the risks, or I will use the ISO 31000 risk management system. All right, quickly put the points down. When you are done mapping out that answer plan, you now go to the first page and you look through it. Which ones can you start with first? This is a written paper, so which one can you really start first? You go to the next page and you write. Maybe the governance question is on the easier side, so maybe question 4A. You start writing out the governance answer. Now you have the pointers already in your answer plan, so you're just picking the point from the answer plan to come and now explain based on the marks allocation and the context of the question. And you do that. And you do that. And you do that. Now, why is the answer plan important? Because now, when you are getting to 2 hours, 15 minutes, 45 minutes to go, people will now be starting to think. You are no longer going to be thinking, because you have prepared your answer plan for almost all the questions, all other things being equal. So when you start the write, you just the flow. You just the flow. You just the flow. Now here's the play. If you are caught up with time, now definitely when you are done, you're supposed to just cross out the answer plan. Okay? So you just cross it out. The answer plan. Now here's the flow. If you are done or you are not done, right? And stop work. The points are in your answer booklet. It will be looked at and you'll get some marks for it. Yeah. But if you had written the point on the question paper with pen or pencil, that question paper, you are taking it to your home. Nobody is interested in that. And Nuntina, you prepare the answer plan. So technically for 2 things or 3. 1, you are fresh in the exam hall. You are reading through the questions. The APO is coming. Thou shalt not write the APO on your question paper. The APO must come in your answer plan. Number 2, because you now have the answer plan, when you start answering the question, you just the flow. You just the flow. So no time for rethinking of, no, because you have the points tabled out in your answer plan. So you're just picking them and explaining them, picking them and explaining them. Then number 3, if it happens that you're not able to answer all the questions, then certainly you will get opportunity, because you have written the points down, to get some marks associated with the points that you have written in your answer plan, because it's still in your answer booklet. So the examiner will look at it and you may get some grace marks in respect of that. So that is the first thing I want you to be mindful of. It may seem like 35 minutes, I'm preparing answer plan. What is that? But if you do that, you don't just read question 1, then you start answering. Then by the time you go and read question 3, oh, this thing, I was learning it yesterday night. My house people. No. You need to apply wisdom in the case study examination to optimize your opportunity to pass the exam. There is no time to be doing, no. Prepare answer plan, reduce your stress, move and go. So that's a key thing that you have to do in the strategic case study examination. Very important. The next thing is to be able to control your emotions during the exam. A lot is going to be happening. Okay? If I tell you to use 35 minutes for planning, as I said, part of your brain is going to say you are wasting time. But you are not wasting time because you are writing the answers to the questions down. And because you are fresh in the exam hall, the points are going to be fresh. And so you have to be able to control yourself. Then sometimes you may digress. You could see that you are answering a question, then you go and read the requirement again and realize that, hey, I didn't say mhunu. So you've written 2 points, but you have to cancel it and start again. You need to be able to control the emotion that you don't start panicking. Because here is the play. If you start panicking in the exam hall, you are on your way to fail the exam. Because when you start panicking and your heart starts racing, your brain doesn't work. Because blood is concentrated on your heart, so your brain doesn't work. So you need to learn to calm down in the exam hall as much as possible. All is well. Calm down. Calm down. So controlling your emotions is going to be crucial in the exam hall. And don't look at what somebody is doing. You see somebody writing. Stay in your lane. Do what you must do and do what you can do. The final thing is when you hear get ready to stop work, put your pen down. I know you're not going to do it, but my job is to tell you what is right. This is a written paper. You can write a lot of insemhunu. And in your brain, you are writing, the entity must adopt the following strategies in order to expand and grow. Point number 1, market penetration strategy. Point number 2, market development strategy. In your brain, that's what you are writing. But the actual thing on the paper could be grammatically wrong, spelled wrong. So get ready to stop work, put your pen down, and read through your work. That is why I talk about emotions. You got to calm down and read through. That time, Nhyira, the point is coming. You want me to stop? And Mboa ako edidi embaya yenkebingum. If the things that you have written in the last 2 hours, 10 minutes has a lot of nonsense in it due to grammar, wrong spellings, and wrong structuring, what makes you think that the 5 minutes write that you are going to write is going to save you? And it is common in same Hunu and Crawfordshire case study examination. So you want to calm down. Get ready to stop work. Just can't read your work. Just do that. And then make sure that, everything is done. Then you can come back, whatever is left, you continue with it. These are the best practice strategies that you must adopt in the strategic case study examination during that 3 hours to optimize your chances or your chance of passing the examination. That's it. I'm done. So, on the overall, nobody cares about your analysis. It's about what is in the syllabus. Number 2, the examination requires strategy. Prepare an answer plan and work with that. Start with what you can do best first. Don't just read question 1 and start. Take your time, read through all the questions. And this is case study. So make sure you understand the context of the question so you do not digress and go and write something that you are not supposed to be writing because you are rushing. Control your emotions. Optimize your time. Work with speed and accuracy. If you can do this, you should be able to pass the case study examination and take your life to the next level. So that is it about that. And I'm going to wrap up around here. And certainly before the examination, if something comes up you want to pick my brain on, you are thinking about something, or you are reading some of the additional issues that I've asked you to read and you want to get some clarity on some things, then certainly you can reach out and you'll be assisted with any explanation that you have to get. But please, go to the syllabus and go to the content of the syllabus. That's it in respect of that. So that's it about that. And this is how far we can come in our discussion. Any other questions for me before I wrap up? Because maybe for my assignment with you. Any other questions for me? Okay, everybody good. All right, so that's it about that. So, wishing you all the best in advance as you begin the journey. Some of you doing writing, corporate reporting, so you're going to be starting on Monday. Some of you are just focusing on strategic case study as well, so you're going to be doing that as well. So, wishing you all the best as you go into the exam hall, and be yourself. Do what you have to do to pass the examination. For the last time, don't die on the Preseen analysis. I know why I'm saying this. I've watched a lot of movies on that. Do not die on the Preseen analysis. Because people have reached the exam hall and their strength was on the Preseen analysis. They went to the exam hall, opened the examination script, looked at the questions and shouted, "Hey!" And that was all. Got up, fine, gone. Because with di baba boni bia, sa baba no, enye ne ba wa exam hall. So you need to be careful about that. So that's it about that. Take care of yourself. Wish you all the best, and we pray that the Lord will give you the strength that is needed and the retentive memory that is required to remember everything that is supposed to be remembered, so that you can actually go into the exam or write the exam with confidence and pass the examination. And we pray that the Lord will be with you so that He will bless the efforts of our work and it will be fruitful at the end of the day. So that's it about that. Ozedeng, thank you very much. It's a pleasure. Okay. All right. So in the live strategic case study folder notes that you have, you're going to be getting access to some of those materials that we went through and access them in the folder, so you can use them and go through them in respect of that. So in the strategic case study summary note folder, you'll be able to access some of the documents that I referred to in my analysis to help you as you revise for the examination. All right? Bye-bye. And we will see you when we see you.